Good evening and welcome to the first intermediate U.S. personal income tax topic, which is going to be the basic credits. There will be a series in this intermediate classes in this intermediate series, there you go. And in the three areas are going to be going deeper, where we're going to talk about the basic credits, as well as getting into filing statuses and talking through various scenarios and different options and why it matters what your filing status is. Then we'll also have a intermediate level look at income, and those classes will include information on retirement, Social Security, the 1099-S and 1099-Cs, as well as a lesson specifically on tip income and 1099 miscellaneous. We'll also cover in a separate lesson flow-through income from K1s, as well as talk about capital gains and brokerage statements. Then the last session of the intermediate series will be working through business impacts, and there we'll be talking about business expenses as a deduction, going through the Schedule C for sole proprietorships, as well as Schedule E for rental properties. But for tonight, we're going to be focusing on the tax credits. So in this lesson, we're going to be covering the child tax credit, the credit for child and dependent care expenses, and the earned income credit, as well as additional child tax credit. There's one more in here. As a matter of fact, I'm just going to add it in. Additional child tax credit. The main thing that we're going to be talking about is the difference between non-refundable and refundable credits, and understanding how you can claim the credits and which ones you're eligible for. So the first thing that we want to talk about is refundable credits versus non-refundable credits. A non-refundable credit can only reduce your tax liability to zero. Once the tax liability has reached zero, you would not receive any money back for any of those credits. So in the case of the child tax credit, which is a non-refundable credit, if your taxable income is actually reduced to zero because of the quantities of exemptions and deductions that you have, then in fact the child tax credit would not give you money back. Refundable credits, on the other hand, can result in a refund even if there's no taxes owed. So refundable credits allow you to receive money back that you did not pay in. A key thing here is that refundable credits are viewed as actual payments into your tax account, whereas the non-refundable credits are simply able to be used to pay the taxes that you owe. We're going to be talking about the child tax credit, the child and dependent care credit, and earned income credit tonight. The first one's going to be the child tax credit. This is a non-refundable credit. You would see it on line 52 of the Form 1040, and it's for up to $1,000 per qualifying child. If you cannot use the entire amount of the credit on line 52, meaning that you do not have a tax liability that exceeds the amount of the credit, then you may be eligible for a refundable credit that's called the additional child tax credit, and that's on line 67, and we'll be covering that in this lesson as well. So the child tax credit and the qualifying child. Your qualifying child, for the purpose of the child tax credit, these are the rules. They cannot have provided more than half of their own support. This is true for any dependent. So they cannot provide more than half of their support. In addition, a qualifying child must be your son, daughter, grandchild, eligible foster child, etc. They need to be a citizen of the United States or a resident alien or a U.S. national in order to qualify for this credit. Under the age of 17 on the last day of the tax return, they must be claimed as a dependent on the return. They need to have lived with you for more than half a year, unless you are the non-custodial parent and the custodial parent has given you permission to carry the child. They also need to be younger than the taxpayer and not filing a joint return. So a qualifying child for the purpose of the child tax credit is slightly more restrictive than just the qualifying child for the purposes of claiming the exemption. The qualifying child tax credit shows here on line 52. And I'm going to give you an example. We have Jay and Tracy, and they have 3 children. 2 are qualifying children and are eligible to take the child tax credit of $1,000 for each child, or a total of $2,000. Their tax liability, which appears on line 47 of their return, is $780. Therefore, the child tax credit would be used only to reduce it to 0 and would only be the child tax credit would only be $780. In their instance, they do not get the additional $1,220 unless they're able to claim part or all of the $1,220 as an additional child tax credit, and that would be on line 67 of the return. So Jay and Tracy claimed their 2 sons and a daughter as dependents. Susie was 6 on July 2nd, Andy was 16 on November 10th, and Jamie was 17 on December 3rd. Which dependents would be a qualifying child for the child tax credit purposes? It would only be Susie and Andy. Jamie would not qualify because they were not under 17 on December 31st. Once you turn 17, you lose that credit. You can still claim them as children on your return. You can still get the exemption. You just would not get the child tax credit. So here we have Nicole. She's 11. She lives with her father, George. George has signed a written declaration that he will not claim the exemption for Nicole. Will Nicole be a qualifying child for the tax credit for George? The answer here would be no. Nicole will be the qualifying child on her mother's return, and her mother will be able to claim the credit. So when George allowed Nicole's mother to carry her on his return as a dependent, he also is foregoing the child tax credit. Child tax credit requirements: you need to be able to claim the exemption for the child, and you actually must claim the child. So not just qualify to claim the child, but actually claim the child on your tax return. You also need to provide a valid tax ID. You may use an I-10, and you need to indicate your relationship to the child. So to figure the credit, you would reduce the amount of the credit if the tax liability is less than the credit. So if you only owed $780, the credit would only be good for $780. In addition, there are caps on the modified adjusted gross income, and if your modified adjusted gross income is above the amounts shown on this particular slide, you would actually see the amount of your child tax credit reduced. So in the case of married filing jointly, if the adjusted gross income is over $110,000, if you're a head of household or qualifying widower or single, it would be $75,000, and if you're married filing separately, it would be $55,000. The child tax credit and how to claim the credit. You would need to file a 1040 or a 1040A, 1040EZ. You cannot have a dependent on a 1040EZ. You need to provide the child's Social Security number in the exemptions section, or the IRS may disallow it. So if you do not have a valid Social Security number or I-10 and provide it appropriately, the IRS may disallow this credit. You also need to complete the child tax credit worksheet, and Schedule 8812 would be completed for every child that you are claiming that has an I-10. Harold and Donald are married and file a joint return. They have 4 children under the age of 17 whom they claim as dependents. In 2014, Harold and Donna have a modified adjusted gross income of $108,498. Is their modified adjusted gross income under the phase-out level? Yes, in their instance, the phase-out level for married filing jointly was $110,000, so they would be eligible for the full $4,000. And in fact, if their tax liability is $4,000 or higher, they would be able to receive benefit from the full credit. The next credit that we're going to be talking about is the credit for child and dependent care expenses. So looking at child and dependent care expenses, these would be for a qualifying person, usually a child, but it could be a dependent who's physically or mentally incapable of self-care, and it could be your spouse who's physically or mentally incapable of self-care, and it doesn't have to be a permanent disability. The qualifying person, if they are a child, the IRS has a limit of 13 years of age. So once that child is over 13, they would no longer be a qualifying person for the purpose of this particular credit. So the credit for child and dependent care expenses, here's an example. Sandy pays someone to care for her husband, Dan, so she can go to work. Dan is physically unable to care for himself. Sandy also pays someone to care for her daughter, Jenny, while she works. Jenny had a birthday and turned 13 on April 15th. Which dependent care expenses can Sandy use to figure her credit? Dan's expenses, Jenny's expenses, all of Dan's and Jenny's expenses, or all of Dan's expenses and Jenny's expenses only through April 14th, 2014. Whenever you have a multiple choice question and one of them has a lot of detail, that is usually the answer. And in this case, it is D, all of Dan's expenses and Jenny's expenses through April 14th, 2014. So she turned 13 on April 15th. So if you paid for the entire month of April, you would only be able to claim as eligible dependent care expenses those paid through April 14th, or those charges that would be incurred up to the day she turns 13. Here's another example. Deanna is 26, but she's not able to care for herself. Her brother pays someone to care for her while he works. He supports her and he can claim her as a dependent. Is Deanna a qualifying person for her brother? And the answer would be yes. Deanna would be a qualifying person and he can claim the expenses for her care. In the event that you have a child who is not in a joint household where both parents are present, the custodial parent can treat the child as a qualifying child for the purposes of child and dependent care expense benefits. And the non-custodial parent cannot treat the child as a qualifying child, even if that child is on their return as a dependent. So if you think about it this way, the custodial parent is the parent that actually has the child living under their custody. And in order for them to work, they would need to be able to provide the care, have someone provide the care so that they can work. The non-custodial parent is not responsible for the child. Therefore, they, through the custody arrangement, they would not be responsible for the child. So in that instance, they would not be eligible to claim this credit either. And it does not matter if the non-custodial parent is the one that pays the daycare expenses through child support. It is the custodial parent who is able to claim this particular credit. So here we have Adam and Cassandra are divorced. Their daughter Sally lives with Cassandra 9 months of the year. The remaining 3, she lives with Adam. Cassandra signed a statement allowing Adam to claim the exemption for Sally. Cassandra pays for daycare for Sally so she can work. Who can claim Sally as a qualifying child for child care expenses? It would be Cassandra because she is the custodial parent. Cassandra can treat Sally as a qualifying child for the credit purposes, even though Samantha cannot claim the exemption for Sally. So in order to be able to claim the credit, the care is for one or more qualifying people. You have to have earned income during the year. The care must be provided so that the qualifying person so that you can work or look for work, and being a student counts. The payments are to someone who is not your spouse and not your child under 19 or another dependent claimed by you. Your filing status may be single head of household, qualifying widower, or married filing jointly. And you must identify the care provider on your tax return. You can't just claim the credit without identifying who the care provider is on your tax return. So we're going to look at a couple of examples here. We have a father who's not claiming his 2 children. They live with him and he pays for daycare so he can work. So in this instance, the dependent is not claimed. It is an eligible expense, and he can claim the credit. The next one, we have a married couple with 3 children. The mother pays for daycare 2 mornings a week so she can take aerobics. In this case, the children are dependents on the return, but it is not an eligible expense because it is not to work or look for work, and therefore the credit cannot be claimed. In the next example, we've got a young couple with 1 child, and the wife was in school for 6 months and paid a babysitter while the husband worked and she studied. And she began working in September, and the baby was with the babysitter all year. The baby is a dependent on their return, and it is eligible expenses because it was used for school and work and not for the other months. Yes, the credit can be claimed. So in this instance, the credit can be claimed for the couple. The next one, the couple above split in April, after which the husband had custody. May he claim the credit? And the answer is yes, and he would also be able to claim head of household, and the eligible expenses would be for all of the months, and he may claim the credit. So he would be claiming the child as a dependent, and whether he claimed the child as a dependent or not, he would still be eligible for the credit. So your work-related expenses, the work-related expenses need to be for the care of the qualifying person while you and your spouse work or look for work, the qualifying person's well-being and protection, and you can count expenses for a child in a grade below kindergarten. So you cannot count tuition or school expenses, but if there is an aftercare program or something similar, you would be able to claim that portion as dependent care. The amount of work-related expenses are eligible for the credit. It's limited to the lowest of the following: the actual expenses, the amount of earned income, and it cannot exceed the amount of income of the lower paying spouse. And then there's a dollar limit of $3,000 for one qualifying person and $6,000 for 2 or more qualifying people. This can be reduced by excluded employer paid dependent care benefits, and we'll explain the employer paid benefits here. The amount of the actual credit is a percentage of the eligible expenses. The percentage that you get to claim ranges between 35% and 20% of the eligible expenses. The percentage is allocated based on your AGI. So this is actually an excerpt from the 2441, Form 2441, and here it shows you if the adjusted gross income is between 0 and 15, you would be eligible for 35% of the approved expenses for the credit. And then if it's over 43,000 and up, it would be 20%. So this chart right here is going to show you exactly which percentage you're going to use to determine the credit. When you're claiming the credit is the total amount of the dependent care benefits, and it's limited to the smallest amount of the total amount of the benefits, which would be in the event that you had a dependent care thing on your W-2, and that's shown in box 10, or the total amount of the qualified expenses, your earned income, your spouse's earned income of $5,000. Benefits that are in excess of the excludable amount are taxable and must be added to the amount that you report on your 1040. So we're going to look at an example here. This is what the dependent care benefit section looks like. On row 12, we're going to put in the amount from the W-2 that was provided for your dependent care. Here in 13, 14, 15, we have a space in the event that you have carryover money that you're bringing over. You want to exclude a portion of this because you're going to carry it forward to 2016. Line 16, we're going to put in the amount of the qualified expenses. So line 16 is going to be the amount that you paid the care provider. Then 17 through 21 gives us an opportunity to look at whether the spouse made more money, which spouse made the least amount of money, whether the amount of qualified expenses exceeded that, and whether or not the amount of eligible dependent care money was it, whether all of it was used up or not. So on line 24, if you have an amount that is over and above the allocated portion for dependent care that was provided and refunded, then you would be able to claim the additional credit here on line 24. And taxable benefits on line 26 in the event that you did not use all of the money that the employer put aside in the dependent care plan, and portion of that money needs to be taxed because it is a tax deferred dependent care account. To claim this credit, you're going to complete a form 2441, and on that 2441 you're going to identify the Social Security number or the EIN of the persons or school or daycare or whatever it is that's providing the care. In the event that the information has areas where it's incomplete or incorrect, the IRS may disallow the credit. Form 2441 is also used to figure the excludable amount of the dependent care benefits provided by your customer. And we just went through that on the last form. Now we're going to shift to earned income credit. Earned income credit is a tax credit for certain people who work and have earned income. The earned income credit is available to taxpayers who have qualifying children, and it can be available to taxpayers who do not have a qualifying child. Because the earned income credit is a refundable credit, you can receive a refund even if you have no tax liability and you had no income tax withheld. The earned income credit is entered on line 66A of the 1040. For the earned income credit, your qualifying child must pass the relationship test, the age test, the joint return test, and the residency test in order to be a qualifying child. So we're going to go through a couple of scenarios. Todd was 19 at the end of the year and he lived with his mother and father who supported him. Todd does not go to school and he is not disabled. Is Todd a qualifying child? And here the answer is no, because he would not meet the age test because he was not under age 19. And therefore he would need to go to school. Since he's not in school, that would be one of the exceptions. So he is not an eligible child. For the earned income credit, the qualifying child, it has to pass the relationship test, which means that they need to be son, daughter, stepchild, foster child, descendant of any of those, in other words, your grandchildren, or brother, sister, half-brother, half-sister, stepbrother, stepsister, or descendant of any of those, for example, nieces and nephews. They need to pass the age test. The age test is under age 19 or under age 24 and a student or permanently and totally disabled. They need to pass the joint return test, which is they cannot file a joint return unless they are only filing the joint return to receive back income tax withholdings, or if they estimated taxes that were paid previously in the year, or if it's to validate the healthcare marketplace. So there's some reasons why you can be on a joint return and still be a dependent and part of the earned income credit. Residency, this is an important one for both the earned income credit as well as the child tax credit. The children have to have lived with you in the United States for more than half the year. It's not a requirement that they live in the United States to be able to claim the personal exemption. The personal exemption is available for children that are being supported by parents from the United States with U.S. earnings, but the children are actually still located in either Canada or Mexico. They don't have to live in the United States to be a dependent on a U.S. return. They do have to be in the United States for at least 6 months in order to be eligible for these particular credits. So all requirements must be met. You and your spouse and the qualifying child must all have valid Social Security numbers. ITINs are not permissible for the earned income credit. They were for the child tax credit. They are not for the earned income credit. Your filing status cannot be married filing separately. You must be a citizen or a resident alien all year. And you cannot have filed a 2555 or a 2555 EZ, which has to do with foreign income. Your investment income cannot exceed $3,350, and you must have earned income, and you cannot be a qualifying child of another person. Your earned income and your adjusted gross income must be under certain limits. So in the case of married filing jointly, it would be $14,590 for single or head of household or qualifying widower, and $20,020 for married filing jointly without any children. This bumps up if you have one qualifying child. It goes even higher if you have two qualifying children. If you have three or more qualifying children for a single or head of household return, it would be $46,997, and if you are married filing jointly, you can earn up to $52,427 and still receive an earned income credit. In the event that you are serving our country and you have combat pay, you'll see that the curve for this credit goes up and then it goes back down. In the case of combat pay, you actually are able to choose whether you want to use the combat pay, and you can calculate the credit for both in both directions and then use the one that provides you with the most amount of money. So here we have Dinah. Dinah is 22 and a full-time college student. She and her 2-year-old son live with Dinah's mother for the entire year. Dinah meets all of the relationship age and residency tests and therefore is a qualifying child for her mother. However, her mother's 2014 investment income was over $3,500. So can Dinah claim the earned income credit with her child? And the answer is no, because she is a qualifying child for her mother. So Dinah cannot claim the earned income credit. Her mother cannot either because of the investment income being too high. Here we have Mark. Mark has 2 children and his wages are $38,000. His adjusted gross income is $43,806, and for earned income purposes, his earned income is going to be $38,000. Can Mark claim the earned income credit? So looking at the limits, he's going to have 2 children and he made under the $43,756. So the answer would be yes. His AGI is not less than $43,000. Because his AGI is not more than $43,000, he can his AGI is $43,806. So it is over the $43,756. I apologize. That's hard for me to read the blue. So the key here is that his AGI is $43,806. So even though his taxable wages and his earned income are under the limit, because his AGI is over the limit, he would not be eligible to claim this credit. So if you have qualifying children, in addition to the income rules, you have to meet the following requirements. The child must meet the relationship, age, joint, and residency tests that we just discussed. Your qualifying child cannot be used by more than one person to claim the earned income credit, and you cannot be the qualifying child of another person. So in the instance of Dinah, she's in school, she's 22 years old, it does not matter how much money she makes. The one exception is that it is a requirement in order to be a qualifying child that you cannot provide more than half your support. So if in fact Dinah is providing more than half of her support, she would not be a qualifying child of her mother, and then she may be eligible for the credit depending on what other factors are involved. So if you or someone else have the same qualifying child, you can decide who gets to claim the credit. And that decision can be for the child's exemption and the child tax credit, In the event that you're talking head of household filing status, you would have to have that child living with you, the credit for child and dependent care expenses, and the exclusion for dependent care benefits. There are 5 tax brackets, but you can't split them. So one taxpayer can't choose to take the child tax credit and then another tax tax payer, the person who is filing the taxes, the mom or the dad, you cannot split the credits up. So you can't say, well, they qualify for both of us, you do these credits and I'm going to do those credits. All of the credits would have to be on the same qualifying parent's return. If you do not have a qualifying child, so meaning there's no qualifying child in the picture, there are additional requirements. Your age must be at least 25 and under the age of 65 at the end of the year. You and your spouse, if filing a joint return, cannot be another person's dependent, and you cannot be a qualifying child of another return, and you must have lived in the United States for more than half the year. Got another example here. Dave is 25 and single. His parents provide over half of his total support. Dave's earned income was $2,875. Because he meets all of the dependency tests, his parents can claim him as a dependent. Who can claim the earned income credit, Dave or his parents? Neither. Dave cannot claim the earned income credit because he's ineligible. He is a dependent. And Dave is not a qualifying child for the purposes of the earned income credit, so his parents wouldn't be able to claim it either because he's providing more than half of his total support. It says, oh. Sorry about that. Claiming the credit. In order to claim this particular credit, you would answer eligibility questions in the tax form, and it just asks the specific eligibility questions. You would complete the earned income worksheet. The earned income worksheet table would show you the amount of your credit. If your earned income and your AGI are different, you would look up the credit for each amount and you would actually claim the lower credit. And if you have qualifying children, you would need to complete the EIC schedule and attach that to your tax return. So here's a summary of the earned income credit rules. Everyone is subject to the AGI limits that we discussed and must have a valid driver's license, must be a U.S. citizen or resident alien. You cannot file a Form 2555. Your investment income must be $3,350 or less. You have to have earned income, and you cannot be married filing separately. Then if you have a qualifying child, you would also need to meet these requirements. The child must meet the relationship, age, and residency, and your qualifying child cannot be used by more than one person to claim the credit. And you cannot be the qualifying child of another person. If you do not have a child, you have to be over 25 and under 65. You cannot be the dependent on another return, and you cannot be a qualifying child for another person. And you must have lived in the United States for more than half of the year. And then in order to calculate the credit itself, we have the income limits again, where you must have your income would be like between $14,590 with no children and filing single or head of household, up through $52,427 for a joint return with 3 or more children on it. So Steve and Jamie are married with 2 children. Their filing status is married filing jointly. In 2014, their earned income is $23,315. Their other taxable income is another $1,184 from unemployment. So it gives them a total AGI of $24,499. Even though the unemployment is not earned income, it would be in their AGI, and you want to look at both numbers and then you would pick the lowest. So that's what we're going to do. looking at the number, the first number, which is their um, actual earned income, was $23,315. So we find here between 23,300 and 23,500, and the amount is $5,446. The second amount was their AGI. Their AGI was a little bit higher, and it was actually $24,499. So that's going to be here, and that was $5,206. So they're going to actually select $5,206 as the answer. Now we have Jake. Jake is single and he has one qualifying child. His earned income was $17,270. His AGI was $17,902. We're going to use the table and find that for $17,270, the refund amount or the credit amount would have been $3,305. For $17,902, the credit amount is $3,290. So which one is Jake going to take? Hopefully he's going to do the right thing and take the lower credit amount, which would be the $3,290. Due diligence. In the event that you are a paid tax preparer and you are working with clients who have earned income credit, it is very, very important that you follow the due diligence guidelines. This has changed over the course of the last few years. It is now a requirement that we ask the questions, we document the answers, and we actually have the paperwork to back it up. Even if you e-file, you can be fined up to $500 per return that does not meet the standards of requirements that have been placed on the earned income credit. So the first thing is there's the Form 8867, where we start to talk about the earned income credit, and the information has to be provided to the taxpayer, and it needs to be obtained in a reasonable manner. So this checklist is pretty exhaustive. You also want to complete the appropriate earned income credit worksheet. You would keep Form 8867 and the worksheet and a record of how and when and from whom the information was used to prepare the taxes. So I actually go into the earned income credit worksheet, and it says, how did you get the answer? Or who did you get the answers from? And I check the taxpayer, or I check the spouse, or I check both of them. And then it says, how did you get the answers? Well, in most instances, I asked the questions. So I would say I interviewed the taxpayer, and they provided this information. Or if the tax client happened to bring in the prior year's returns and the information was in there, they confirmed that it had not changed, I might use the prior year information that was provided. But this Form 8867 is very specific as it relates to the children and also as it relates to the income, because with a refundable credit, this is money going out that was not paid in. Okay, we're going to look at where we are with some earned income credit, some different scenarios. So in the first one, you have clients that are separated. The spouse has minimal income and he's claiming head of household with the child for the earned income credit. Well, the fact that they've got minimal income, and minimal income is a judgment call. It's listed as minimal, so we would assume that it means minimal, $2,000, $4,000. That level of income is not consistent with being head of household. If that person is actually married filing separately, they would not qualify for the earned income credit. So what the tax preparer could do is ask the client about details. Do they support themselves? Do they consider themselves their own household? You want to ensure that any spousal support is not more than half of the taxpayer is providing. So if they have additional children and they're claiming head of household on the children, but it looks like the other spouse has more a higher income, that head of household might be questioned. Next client, 18-year-old, has an infant, wants to claim the earned income credit, and has a total of $10,000 in earnings. the taxpayer is 18 and therefore would meet the age test for the qualifying child for the person who we're doing the taxes for. So if that qualifying, if that 18-year-old is actually a qualifying child, they would not be able to claim their infant for the purposes of earned income credit. We've looked at a previous example similar to that. The appropriate action would be to ask questions about living arrangements to ensure that the taxpayer is not a dependent of another taxpayer. If you determine that they are, you would simply tell them that they're not eligible for that credit. The taxpayer would be, in this scenario, claims to be self-employed. However, they have no records and no expenses. So they come in and they say, well, I've got this business and I made $10,000. Any Schedule C return should show both income and expenses. Should show both income and expenses. So we understand that if you started a new business and you started it in October, or it could be even if you started it in January and it is something with a long ramp-up period, that you may have only expenses and no income, but that should be an exception. You would expect to see both expenses and income. So the appropriate action would be to work with the client to recreate the records using bank statements and anecdotal information. And if you ever are in a situation where you need to do that and work with a client, where you yourself find yourself needing to reconcile statements, this is why it's a great idea, even if you have the paper statements, to download the electronic statements from the banks. That would help in the event that you need to recreate records. Child-based tax credits. Here are the child-based tax credits that we talked about tonight. We talked about the child tax credit. This is up to $1,000. You would be able to get the credit if you claim the exemption. So the credit goes with the exemption here. And if you have primary custody, but you did not keep the child, they're not your dependent, then you would not be eligible. So you don't have to have them all year to be eligible for the credit. If you just are the non-custodial parent, you would be able to get the child tax credit. So it's not required to receive the credit. The additional child tax credit goes with the exemption. If you get the exemption, you qualify for the credit. You do not have to have custody in order to receive additional child tax credit. Dependent care credit. The dependent care credit goes with the primary caregiver. So the dependent care credit does not matter whether or not you claim the exemption. You can give the exemption to the other parent and still claim the dependent care credit. As far as earned income credit goes, again, this is something that does not follow the exemption. It follows the custody. So whichever parent has custody of the child would be eligible to claim that child for earned income credit. And if you do not have the child on your tax return, you can still claim the earned income credit. And even in most of the tax software will now accommodate that. Looking at a summary of the credits again. The child tax credit is non-refundable. The key things here is the child must be under 17, must be a U.S. citizen or national, and had to have lived in the U.S. There are modified adjusted gross income thresholds. In the event that you make over the threshold, the tax credit could be phased out and in fact eliminated. As far as the additional child tax credit, that is a refundable credit, and it is based on your earned income. And what it is actually 15% of your earned income over $3,000. So if you made $4,000, you would get $150 of the credit you'd be eligible for, because you take the 4,000, subtract the 3, take 15% of the 1,000, and you get $150. Dependent care credit. This is non-refundable. It is only used to set your tax liability down to 0. Both parents on the return must have earned income. The amount of the credit is based on the actual expenses and the lowest earned income of both parents. And then there's a cap as well of $3,000 for one child or $6,000 for two children of the actual expenses. So whichever's the lowest, if your actual expenses are less than the $3,000 or $6,000, you would use actual expenses. If your earned income is less than your actual expenses, you would use your earned income. So that is the lowest common denominator on that dependent care credit. Regarding the earned income credit, that also is a refundable credit. Earned income is required. If you do not work, you do not get this credit. If you have unemployment only, you would not get this credit. If you have passive income only, you would not get this credit. So if you are receiving disability payments or third-party sick pay, if it's third-party sick pay, you would need to talk to a tax professional, because sometimes that would be eligible and sometimes it would not. It would depend on how it's coded and what the payments are from. So I've got a couple more slides here. With the credits that we've discussed, you have to have earned income, as we just said, in order to claim the earned income credit. You can elect to include the non-taxable combat pay if you're serving this country and you have income on your W-2 that's coded with a Q for non-taxable combat pay. You can calculate the credit both ways and choose whichever way is most advantageous to you as the taxpayer. And in the event that you are a tax preparer, you want to ask sufficient questions in order to comply with due diligence. It is important that a professional tax preparer does not know or have a reasonable reason to know that there is anything fraudulent or out of line on the return. So for example, if you have a 23-year-old who comes in and is claiming 16-year-olds, and they say that they are their child, their daughter or son, that's inconsistent with those ages. At that point, you should be asking questions as to how that happened and documenting it onto the return as well. Tax preparers are subject to a penalty if you are not following the due diligence requirements. There is EIC training available on the IRS website. I would encourage you if you are preparing taxes as a professional, or even if you're just preparing taxes on behalf of family members, if they are qualifying for the earned income credit, it would really be to your benefit to go on to that IRS website and review the earned income credit due diligence portions. This course has been brought to you by Freedom Financial Partners. I'm Ginger Garvey, Senior Partner, and we have based this class on information in the publication 17, publication 972, publication 596, using forms 8812 and the form 2441. If you have any questions, please feel free to send us an email. We're happy to hear from you and to help you out. Good luck with the tax season and best wishes. Have a good night.